What are the stocks to watch in April? This is a question that we often encounter in our journey into the intricate world of finance and investment. The stock market, with its complex maze of numbers, graphs, and estimations, is a world in itself, a world that is constantly evolving, changing, sometimes even on an hourly basis. As we venture into this labyrinth, we are effectively setting sail into an ocean of figures, trends, and stock market is a dynamic entity, reflecting the ebbs and flows of the global economy. It is an entity that is influenced by a myriad of factors, from geopolitical events to technological advancements, from natural disasters to mere rumors. It is a field where the stakes are high, where fortunes are made and lost within the blink of an eye. Navigating the stock market is no easy feat. It requires a keen eye, a mind attuned to the intricate patterns that underlie the flux of figures, and an understanding of the complex interplay between various market forces. It is a realm where knowledge is power, where the ability to anticipate, to predict the future course of events, can mean the difference between financial success and failure. Predicting the stocks to watch is an art in itself. It is a skill that requires not just a deep understanding of the stock market and but also an understanding of the broader economic and political landscape. It requires the ability to sift through a sea of data to identify the key trends and patterns, to discern the signals amidst the noise. There are various tools and strategies that can help us in this endeavor, from technical analysis to fundamental analysis, from quantitative models to qualitative insights. We have a whole arsenal at our disposal. Yet it's the judicious use of these tools, the ability to synthesize information from various sources and to make informed decisions, ultimately determine our success in the stock market. As we analyze the stocks to watch in April, we must not only focus on the potential returns, but also consider the associated risks. We must strive to strike a balance between reward and risk, between ambition and prudence. Understanding this delicate balance is key to successful investing. In this sense, the realm of finance and investment is not just a science but also an art. It is a field that requires not just technical acumen, but also strategic thinking, creativity, and intuition. It is a field where the ability to see the bigger picture, to understand the grand scheme of things, is just as important as the ability to crunch numbers and analyze data. As we delve into the labyrinth of the stock market, we find ourselves navigating through a sea of figures, trends, and predictions. First up, we have the major US banks such as JP Chase, Citigroup, and Wells Fargo. These financial powerhouses not only represent a significant portion of the American economy, but also play a vital role in the global financial landscape. They are the backbone of the lending industry, facilitating commerce and fueling growth not just domestically, but globally. They are truly the titans of finance. In this first, they haven't just met the earnings expectations but have exceeded them. This performance isn't a small feat, it's a testament to their resilience and strategic acumen in navigating the tumultuous waters of the financial markets. It's a reflection of the robustness of their trading divisions and their ability to generate solid trading revenue. The robustness is a consequence of their diversified portfolios and their adeptness at risk management. In addition to this, they have also demonstrated their ability to manage credit loss provisions effectively. This means they've been successful in controlling the financial losses that could have arisen due to borrowers or bond issuers defaulting on their obligations. Lower credit loss provisions further indicate their prudent lending practices and careful risk assessment strategies, which have been instrumental insulating them from potential financial shocks. However, pre-market trading saw major indexes losing ground. This unsettling development is symptomatic of the volatility that characterizes financial markets. A market characterized by its unpredictability, where billions of dollars change every day. The S&P 500, a market index that measures the stock performance of 500 large companies listed on stock exchanges in the United States, is in fact set for a second consecutive weekly retreat. It's becoming increasingly clear that geopolitical tensions and concerns about inflation and interest rates are impacting market sentiment. These elements, often outside the control of corporate decision-makers, can significantly influence the direction of financial markets. The uncertainty around these issues can cause investors to become cautious and markets to fluctuate, which can affect the performance of even the most stable securities. The outlook from bank executives on the economy in a higher-for-longer rate environment will be closely watched. As influential figures in the financial sector, their perspectives, opinions, and predictions often shape market expectations and investment trends. The financial sector, however, started to lose momentum as yields spiked. This is indicative of a shift in the market dynamics, where investors, in the face of growing uncertainty, started seeking safety in mega-cap tech stocks. These are companies with market capitalizations in excess of $200 billion. They are predominantly in the technology sector and are characterized by their stability and massive growth potential. This shift in investment could mean a change in the market narrative. It's a sign of the evolving financial landscape where technology is playing an increasingly dominant role. It may look like this is just another development in the ever-changing of finance, but the implications of this might be far-reaching and could shape the investment strategies for years to come. This shift in investment strategy could mean that tech stocks are the ones to watch in April. This change might bear the promise of new opportunities, new potential to explore, and new horizons to venture into. The world is watching the financial stage with bated breath, waiting to see how this all unfolds. Next, let's turn our attention to the University of Michigan's Consumer Sentiment Report. This document, a widely respected and closely followed indicator, captures the pulse of the average consumer's confidence in the economy. It is considered significant because it can provide insights into the future direction of the economy. The report encompasses a broad range of information, from employment outlook to personal financial situations. A vital aspect of it is the projection of future inflation and interest rates. These factors are often key considerations for investors when making decisions about where to allocate their resources. For this report is quite palpable in the financial world, given its potential implications. The University of Michigan's report is significant because it is expected to reflect consumers' concerns about rising gas prices. Gas prices don't just affect those who drive, they have a ripple effect throughout the economy, influencing everything from the cost of airline tickets to the cost of goods transportation. Rising prices at the pump can also lead to increased costs for businesses, which could then be passed on to consumers in the form of higher prices for goods and services. Inflation is another issue that's closely monitored through this report. When inflation rates increase, it erodes the buying power of the consumer dollar. This phenomenon affects everyone, from the average consumer to the large-scale investor. It impacts how much consumers can buy, and in turn, can have serious implications for companies rely heavily on consumer spending. Consumer spending is a massive component of the U.S. economy, accounting for about 70% of total economic activity. Therefore, any fears or concerns consumers have about their purchasing power could have a profound impact on financial markets. Worries about gas prices and inflation could lead to consumers tightening their belts, resulting in less spending overall. These concerns could impact consumer spending, and thus, the performance of stocks and sectors reliant on consumer spending. Any change in consumers' behavior can send shockwaves through the economy, particularly impacting sectors that rely heavily on consumer spending. This ripple effect can lead to fluctuations in the stock market, creating opportunities for investors but also potential risks. And that's why this report, and its implications, should be on every investor's radar. As we approach the middle of April, our focus turns to the financial landscape and its many vital components. It becomes evident that a careful and vigilant observation is required on certain key players. These include the major U.S. banks, a vital backbone of the economy, mega-cap tech stocks, the giants of the digital age, and sectors that heavily rely on consumer spending, the lifeblood that fuels our markets. The major U.S. banks, a term synonymous with influence and power, have a tremendous impact on our economy. These financial powerhouses not only control vast sums of wealth, but they also dictate the financial well-being of countless businesses and individual investors. To comprehend the significance of these institutions, one must understand their role in lending decision-making and influencing economic policies. Mega-cap tech stocks, on the other hand, represent the innovation and technological advancements of our time. The performance of these stocks is often seen as a barometer for the state of the technology industry. Companies like Microsoft, Apple, Google, Amazon, and Facebook have dramatically changed the way we live our lives. Their stock performance reflects their growth, market relevance, and technological advancement. Furthermore, sectors that rely heavily on consumer spending should not be overlooked. These sectors, retail, hospitality, automotive, and many others that depend on consumers' buying power. The performance of these sectors can give us a glimpse into consumer behavior, their confidence in the economy, and their willingness to spend. The performance of these stocks, and therefore the sectors they represent, will be influenced by a multitude of factors. These factors include, but are not limited to, the economic outlook, which provides a glimpse into the future health of the economy. Inflation is another significant factor that could sway the performance of these stocks. Inflation can erode purchasing power and increase the cost of goods and services, which can directly impact consumer spending and corporate profits. Interest rates also play a crucial role. They influence the borrowing costs for companies and consumers alike, affecting investment decisions and consumer spending. Lastly, consumer sentiment, which is a measure of how optimistic consumers are about the economy's health, can directly impact the performance of consumer-dependent sectors and the overall economy. The performance of these stocks will be influenced by a multitude of factors, including economic outlooks, inflation, interest rates, and consumer sentiment. In conclusion, the stocks to watch in April are those of major U.S. banks, mega-cap tech stocks, and sectors reliant on consumer spending. These sectors have been identified as areas with potential for significant growth and volatility, making them attractive for different types of investors. Primarily, the performance of major U.S. banks is closely monitored due to their significant influence on the health of the American economy. Their stocks often serve as indicators of wider economic trends. For instance, in times of economic growth and prosperity, these stocks often thrive, reflecting consumer confidence and increased financial activity. On the other hand, during economic downturns, these stocks tend to suffer, mirroring the struggles of the broader market. Mega-cap tech stocks are another category to focus on. Generally, these companies hold a massive market capitalization of over $200 billion. They are typically large, well-established technology companies like Amazon. Given their size and influence, movements in these stocks can greatly impact the broader market. Mega-cap tech stocks are well known for their innovative approaches and their potential for significant growth, especially in today's digital age. However, they can also be volatile, reacting sharply to market news and changes in consumer behavior. Lastly, sectors reliant on consumer spending are of particular interest. These include the retail, entertainment, and hospitality sectors, among others. With the rollout of vaccines and the gradual opening up of economies worldwide, there is a possibility of a resurgence in consumer spending. This could potentially trigger an upswing in these sectors, offering attractive returns for investors. But once again, there's a flip side that must be considered. These sectors are also incredibly vulnerable to shifts in consumer sentiment and buying behavior. Any negative news or event could potentially trigger a sell-off, leading to significant drops in stock prices. Therefore, the importance of staying updated on economic trends, market news analysis cannot be understated. In a rapidly evolving market landscape, having current, accurate knowledge is paramount. It enables investors to make well-informed decisions, anticipate market movements, manage their portfolios effectively, and maximize their returns. However, investing in stocks is not without its risks. While the potential for high returns is appealing, the possibility of losses is equally real. It is crucial for investors to understand their risk tolerance and investment goals before jumping in. The stock market is not a place for reckless gambling, but rather a platform for strategic, informed investment. Analyzing and understanding these trends can help investors identify opportunities and mitigate risks. It can guide them in diversifying their portfolio, balancing high-risk, high-return stocks with low-risk options. In other words, the key to successful investing lies in maintaining a balance between risk and reward, ensuring that potential losses are cushioned by gains from other investments. As the saying goes, fortune favors the bold. And in the world of stocks, boldness comes from knowledge and insight. So keep watching, keep learning, and keep investing. Voiceover. Before we wrap up, here's a quick reminder for you all. If you found this video helpful, please give it a thumbs up. Your likes not only show your support for our content, but also help others in the YouTube community discover our work. We strive to provide you with the latest insights and trends in the stock market, making complex investment strategies more accessible. We believe that knowledge is power, and our mission is to empower each one of you to make informed investment decisions. If you are not already part of our community, we strongly encourage you to hit that subscribe button. By subscribing, you ensure that you never miss an update from us. We regularly post videos on various investment topics, market analysis, and tips for both beginners and seasoned investors. Remember, your support helps us create more content like this, so don't forget to like and subscribe. Together, let's navigate the dynamic world of stock investing.